Welcome to our annual State of the Markets presentation. As you can see, we're going to focus on four key questions. How did stocks perform in 2023? What drove market performance in 2023? Where are we now? What do major financial firms forecast for 2024?
The S&P closed at 4769 at the end of 2023, a gain of 24% and well above the most optimistic expectations for major Wall Street analysts. As we can see, forecasts fell well short of how stocks performed. There may be several reasons for this. The first reason may be that observers and economists expected a recession in the first half of 23 that never came. They also saw higher interest rates and bond yields as depressing stock returns. Also expected by most experts and investors alike was the swell of AI, or artificial intelligence enthusiasm. Few imagined the progress, widening interest, and implementation of AI. As AI developments unfolded, they sparked a powerful lift in the technology companies, which buoyed the rest of the stock market. Stocks also benefited from falling yields as inflation decelerated faster than many had anticipated, leading to hopes of a Fed easing. Despite periodic worries over the health of regional banks and episodic worries that the Fed may remain restrictive for longer than hoped for, stocks moved higher, closing strongly in the final 2 months of 2023.
After a disappointing 2022, stocks moved higher to start the year and continued higher for the remainder of the year outside of a few notable retreats. I want to draw your attention to the plot points on the graph because they highlight the key storylines that drove the stock market in 2023. They come down to two broad themes: the track of inflation and the Fed. As you can see in the early part of the year, the Fed is still hiking rates in the face of still too high inflation. Nevertheless, the market is moving higher perhaps for two reasons: bargain hunting and anticipating inflation will moderate, and the Fed will eventually stop its rate hikes. As we look at the data points later in the year, sure enough, inflation is coming down, and the Fed is now pausing on further hikes, so much so that by the December FOMC meeting, the Fed is signaling rate cuts for 2024. Of course, markets never move in a straight line. There were some more hiccups in this advance. One was the so-called regional bank crisis in March and some backtracking on inflation progress in September and October. A relatively strong economy and a jump in inflation caused some concern in the fall that the Fed may not have room to ease, which is why we saw bond yields peaking in October. However, as inflation resumed its decline, by December, the Fed was comfortable signaling to the markets that rate cuts may be in the offing in 2024. Finally, keep in mind that amid falling inflation, labor markets remained robust and the economy was reasonably healthy, which raised hopes for a soft landing.
Corporate earnings are one of the factors that drive stock prices over the long term. As the chart shows, the earnings growth for the S&P 500 companies appears to be emerging from what market watchers call an earnings recession. That is, where there are at least 2 straight quarters of negative earnings growth. And as you can see, corporate profit growth decelerated in the 3 quarters preceding the most recent quarter of reporting, the third quarter 2023. Overall, companies struggled in the recent quarters due to rising prices and global economic growth slowdown. But Q3 was more encouraging as companies recorded positive profit growth for the first time since the third quarter of 2022, aided in large part by reviving the consumer spending. While the third quarter growth was welcomed, it was driven by just a few sectors of the economy. And this narrow contribution to earnings growth is concerning and leaves some investors worrying about the durability of earnings growth in the year ahead. We already touched upon some of these economic numbers, but let's spend a little time getting a broader view of the economy in 2023. This year, the word used by Wall Street and economists alike was resilient. They remarked on our resilient economy, our resilient labor market, and the resilient consumer. As this table illustrates, the description is an apt one. With fresh interest rate hikes throughout the first half of 2023, on top of unprecedented rate hikes in 22, many felt like the so-called demand destruction efforts by the Fed to lower inflation would do just that, reduce consumer and business demand by making purchases and capital investments more expensive. While such rate hikes can take a while to work themselves through the economy and whose lag effects may yet still be felt, the actual experience was that the economy grew at a respectable rate and is slated to expand nicely in the fourth quarter. And the labor market was strong beyond many experts' ability to explain it. All the while, inflation maintained its downward trend from its height in 2022. The economy in 2023, however, had its issues. Consumer sentiment has remained low and stagnant, and though this seems paradoxical amid healthy economic growth and strong employment, consumers have been especially concerned about the high cost of goods and services. Many experts forget that the sharp run-up in prices of 22 hasn't come down, even if today's inflation rate has. The reality is that despite disinflation, prices today are much higher than they were pre-pandemic, which has soured the mood of many Americans, especially those who are least able to bear the financial burden of higher prices. We also see pessimism in the housing market as reflected in the sentiment index of home builders. Mortgage rates and climbing home prices have left builders and prospective homeowners discouraged about the affordability of buying a new home.
So we've looked at some of the factors affecting market performance in 2023. Let's look at where we are now and examine the headwinds and tailwinds that could affect the direction of economic growth and financial markets in 2024. To create some context around where the economy stands now, let's examine where we stood in November 2020. I picked this as a reference point since it represents a moment in which the nation was finally emerging from the pandemic, though not completely out of it, and Americans went to the polls to vote in national elections. As the indicators suggest, the outlook for the next 3 to 6 months was mixed. The Federal Reserve's monetary policy was still accommodative, and interest rates sat at historical lows. Nevertheless, the economy appeared weak, hurt by consumer sentiment and the labor market. I want to draw your attention to inflation in the bottom left-hand corner. It still looked unthreatening at that time. Now, let's look at the end of 2022, when many economists and market watchers predicted a recession in 2023. As the indicators suggest, there were good reasons to worry about a recession. As we can see, no economic or financial indicators suggested a strong economy or stock market. Important measures like consumer spending, corporate profits, and inflation were neutral, while monetary policy, housing, interest rates, and leading economic indexes were all flashing red. Fortunately, the economy and stock market were a bit more resilient than many imagined. Despite the gloom entering 2023, the economy and stock market would defy expectations, a reminder that investors should pause before adjusting their long-term investment plans.
Now let's take a look at January 2024. As the indicators suggest, caution may be a good word to describe the economy as we enter the new year. Consumer spending, corporate profits, inflation, monetary policy, housing and mortgages, interest rates, and leading economic indicators are all neutral. Additionally, geopolitical risk and international economic categories are red. It seems that despite the stock market's end-of-year rally, nearly all of the financial indicators remain neutral as we enter the presidential election year. Let's examine one of those speedometers more closely, the Leading Economic Index, or LEI. This index includes 10 components ranging from stock prices to manufacturing orders. This data may give a clearer view of where we are when examined together. As this chart shows, the outlook trended lower throughout 2022 and 23, though it appears to have bottomed out at the close of 23. The LEI has been accurate in anticipating the 3 recessions since the year 2000. However, it appeared to signal a recession for 23 incorrectly. In fact, GDP growth rose even as the LEI was painting a weaker economic picture. So, while no economic indicator is ever 100% perfect in predicting the economic future, the LEI remains an important input in developing our views about the economy in the coming months.
In the leading economic indicators and economic speedometers we just reviewed, it's clear that uncertainty is a watchword for the economy in 2024. The first potential headwind facing the markets is inflation. While inflation has come down from its post-pandemic highs, it has remained persistently above the Fed's 2% inflation target. It may handcuff the Fed a bit if inflation remains stuck in the 3 to 4% range. However, at its final meeting in 2023, the Fed said it anticipates 3 rate cuts in 2024. That leads to our next potential market headwind, recession. The much-feared recession did not materialize in 2023, but recessions are a natural and inevitable part of the economic cycle. While a case may be made for avoiding a recession this year, there are plenty of reasons a recession may emerge. Among them are resilience of consumer spending, continued global economic weakness, especially in China, and the surfacing of the delayed impact of a steep rise in interest rates over the last 2 years. Corporate earnings may even be a headwind. If stock prices are to move higher, they need to improve from recent levels. We earlier showed how third quarter earnings have hinted at this recovery. The market's current valuation level may have already priced in this recovery, and should the expected growth in earnings fail to materialize, it will be difficult for stocks to rise from these levels. Geopolitical tensions are always a wild card for the markets. First, it was the unanticipated invasion of Ukraine in 2022, and now it's a conflict with Israel in 2023. Looking ahead, we see a stalemate in Ukraine, ebbing Western support, and uncertainty to what follows in the Gaza Strip. And of course, China's muscle flexing in the Pacific region remains worrying. Finally, the stock market has competition for investor dollars. With bond yields at levels not seen in decades, many investors may find that they can obtain reasonable returns at less risk, leading to fewer dollars to support higher stock prices. While the headwinds facing stocks are uncertain, they're not to be underestimated. There are several potential tailwinds that may support the financial markets in 2024. One reason for the rally in the fourth quarter of 2023 was a continued deceleration in inflation. If inflation maintains its downward trend, it will be positive for stocks since it may help increase corporate profits and allow the Fed to move ahead with rate cuts in 2024. The caveat here is that the Fed has said it will need to stay committed to the inflation fight. Another potential tailwind is a prospect of China returning to strong economic growth, which can have broad benefits for the global economy. China's economy has been struggling under the weight of a late lifting of COVID-related restrictions, among other factors. Nevertheless, they remain a dynamic economy that may only be a government intervention away from a recovery. Finally, there's a start of a new economic revolution akin to electricity and computers. Of course, I'm referring to artificial intelligence, or AI. The emergence of AI was a big story in 2023 and a major catalyst for the markets. Much of the excitement was based on the future potential. This year, we may begin to see the initial real-world impact of businesses as AI potentially turns into a new and substantial revenue stream for the AI ecosystem of providers, from chip makers and software companies to cloud providers through which these AI models operate. Perhaps more importantly, we may also see non-technology companies begin wider implementation of AI in marketing, sales, operation, and administrative functions to drive growth, productivity, and higher profits.
Before discussing the 2024 forecasts, let's examine this chart to see where stock prices trend against historical averages. The most common way to do this is to look at the PE, or price to earnings ratio, which measures investors' willingness to pay for a company's earnings. Looking at the dotted line in the middle, you can see that the PE for the last 25 years is, on average, 16.76. You can also see that the PE moves around quite a bit, with a peak in 1999 and a trough in 2008. The chart shows that the PE was 17.83 on September 30th. Does that mean that stock prices will head lower or climb in the months ahead?
Before discussing Wall Street analyst predictions, let's examine some important inputs that may impact the stock market's direction in the coming year. As many of you know, corporate earnings may be a key driver of stock market performance in 2024. According to FactSet, a leading financial data and analytics firm, earnings are expected to trend higher in 2024, plateauing by the fourth quarter. While it is a good sign, it's also difficult to say how much of that earnings growth expectation has already been priced into stocks, especially in light of their current valuation levels. Estimating quarterly earnings is difficult. Such estimates can help guide decisions about what price to pay for a stock. If earnings are healthy, it may support higher prices. Conversely, should earnings come in short of expectations, it may put downward pressure on stock prices. The course of stock prices in 2024 may be correlated to the Fed's decisions about interest rates. One tool traders look to understand where rates may be heading is the CME FedWatch tool, which analyzes the probabilities of future target rates, as implied by the 30-day Fed funds future pricing data. If we look at where the market thinks the Fed is going, we see that the market believes there's an almost 42.5% probability that the federal funds rate falling by 50 basis points or a half a percentage point by June end. In early December 2023, the Fed funds rate was 5.25% to 5.5%. Traders also price a nearly 20% probability for a 75 basis point decrease within the first 6 months of 2024. While there's a 30% likelihood of just a quarter of 1% cut, there's only a 7% chance that rates will remain unchanged by mid-year. The market's optimism has often raced ahead of the Fed's intentions, so investors should be cautious. However, if these cuts come to fruition, it may have positive implications for stocks.
Economic forecasters surveyed by the Philadelphia Fed in the fourth quarter updated their outlook for Q4 2023 and all of 2024. They slightly increased their expectations for Q4 GDP growth to 1.3% from 1.2%. In 2024, they anticipate positive growth each quarter. So, at this point, no recession appears in the forecast. Interestingly, their unemployment rate projections stay flat throughout the first half of 24, with a slight uptick toward year-end. It'll be interesting to see how and if or when economic growth influences that unemployment rate.
Aside from interest rates and inflation, one of the most critical factors that may decide how the economy and the stock market do in the new year is the health of the consumer. Consumer spending represents about 2/3 of the American economy, and if the consumers pulled in their spending in 2024, it could have consequences for the markets. Consumer spending trended higher following the pandemic, first on goods as Americans spent time sheltered in their homes buying stuff, and then on services like travel once the COVID restrictions were lifted and they felt comfortable leaving their homes. This bulge in spending was lifted by what economists called excess savings, i.e. the amount of savings over the level that would have likely been reached without the pandemic. The primary source of those excess savings were not spending on things like commuting to work, clothes, and dining out. And 2, government transfer payments, i.e. stimulus checks. As we can see from the chart on the left, the amount of excess savings has declined with time, leading some economists to wonder if consumers can maintain their pace of spending. Now, if we look at the chart on the right-hand side, we see consumers' debt levels from auto loans to credit cards. Credit card balances often get the most attention in financial news, but all 5 categories are important to watch. Will the combination of shrinking savings and changes in household debt influence consumer spending habits? That's difficult to answer, but consumers can surprise the experts. One key positive is that Americans are broadly employed, and for now, they can find work if they need to.
So, what are the major financial firms forecasting for the domestic stock prices in 2024? As they did for 23, analysts are painting a mixed year for stocks as the average forecast sits about where stocks ended in 2023. You'll notice significant divergence in these forecasts, running from as low as 4,200 to 5,100. This range of sentiment from bearish to modest optimism may be largely attributed to many of the issues we discussed earlier in the presentation. Will the Fed cut rates or keep them high for longer? Will we have a recession? Will it be that hoped-for soft landing? Or will the economic landing be harder? Will corporate profits grow into current valuations? And will inflation continue to decline? Many of these are binary events. For instance, the Fed will cut rates or it won't. This set of binary possibilities has resulted in much uncertainty as we head into 24, and that uncertainty is shared by market experts from the most prominent firms. Of course, no one knows what equities will do in 24, and predictions at this stage are just that, predictions. I want to end our investment discussion with a word on the importance of investment discipline, or sticking with your investment strategy. The potential of stocks to help build wealth over a long term may be challenging when investors move in and out of the financial markets. If we look at this image, we see a direct correlation to the probability of having positive gains in stocks with the time such investments are held. So, for instance, over the last 94 years, 73% of all one-year periods had a positive return. However, if we travel out to longer holding periods, we see the likelihood of investment success rising to 84% for 3-year periods, 88% for 5-year periods, and 94% of the time for 10-year holding periods.
Here are some action items for you to take this year. Number 1, keep us informed of important life changes. Also, tell us about your investment concerns. And also, and this is very important, make sure your essential documents are up to date. Here are steps we'll be taking this year for you. Number 1, keeping you informed through regular communication. Number 2, managing your investments according to your personalized strategy. And number 3, keep you abreast of economic factors and adjust accordingly.